Hello and welcome back to The Note. The first moment of truth for this week is at hand. We are about to hear from the Federal Open Market Committee at the meeting which for a long time many people thought would see the unveiling of the first rise in the Fed's target interest rates since 2006. We now know almost for certain that that's not going to happen. They haven't prepared the market for it. Any market indicator you look at gives a pretty much zero chance that we will actually see rates rise tomorrow. It would be a market shock for the ages if that really did happen. However, this is still a very important meeting. First of all, we need to hear Janet Yellen's guidance. If she specifically mentions the month of September, that would tip expectations much more towards a rise in September, which at the moment is the earliest anybody thinks it could happen. That would be thought of as hawkish, it would be bad for stocks, it would push up bond yields. The other critical new point of information will be the latest version of the now infamous dots. This is the chart that the Fed governors publish in which each of them shows their projected interest rates over time into the future. We will almost certainly see those dots lower. In other words, we will almost certainly see governors expect the rate of increase to be slower and longer than they had previously projected. Exactly where that moves could also have a big effect on markets. But I'd like to make the broader point, if we take a look at this chart, which is borrowed from or derived from the Fed Fund futures market. It shows you the anticipated interest rate at the end of this year, and you can see that it's not so long ago that people thought that we would have had several rate rises by the end of this year, that interest rates would be over 1%. At the moment, with a projected rate of less than 0.5% at the end of this year, it's basically telling you that it's scarcely better than a 50-50 shot that we'll even get one rate hike this year. This anticipation of rate rises has been delayed and delayed and delayed. Further, if you take a look at 10-year bonds, their yields have risen recently, but they peaked last week still just below 2.5%. When they went below 2.5% during the crisis year of 2008, that was the first time they had been that low in more than half a century. These are still remarkable low yield, low rate times. It's still not clear that the end to those low rate times is anything like imminent. Any steer we get from Janet Yellen tomorrow on this could be very interesting.